EG pack, which is clearly looking interesting. Just want to see where the first trickle of rates has actually settled down. About 0.5% lower is where we're currently at. Nestle, of course, is seeing one-way move up, 2.25% right now as well, backed by Unilever, 1.4% higher. PNB Housing as well is seeing a follow through after that near about 8% move yesterday. That stock also holding higher by about 1.5%. Motherson holding up 1.5%, and Adani Power along with Tata Consumer and Tata Motors PV are some of the other strength stocks this morning. Look at HCL Technologies, it's dived about more than 8%. TechM is down nearly 4%. Infosys is down 2.6%. TCS down 1.3%. And today, ICICI Bank as well has put a sort of pause button, 1374, 1% down. L&T as well lower, along with BEL. But let's welcome on board Pankaj Mudarkar and ask him what he recommends doing in this market. Pankaj, hi, morning. Great to have you on the show. Pankaj, quite swiftly, we've recovered 10% on the index alone from those March lows. Where do you think the market is headed next after that first leap that we've already taken now?
Morning, Aisha. Is certainly headed higher. I mean, it's as simple as this. So I think markets have absorbed the macroeconomic shock. While from an earnings perspective, I think we will see an impact of rising oil prices, the currency adjustments, and rising bond yields also have moved because what came across in March with rising oil prices was a perfect macroeconomic shock for India. While all of this will have an impact on earnings probably in the first quarter and probably in the first half as well, but I think markets will look beyond that. Probably I think the earnings recovery which we were looking forward to in FY27 or in this financial year probably will get pushed back to second half of the year. But I think markets are looking forward to that, and markets I think have priced in that shock in terms of earnings adjustments. And as I said, having said all of this, the underlying growth in India remains fairly resilient. So in that context, I think we are poised for, if you ask me my take, I think we are poised for a new high by the end of this year on the index.
Um, which sector will lead to a new high by the end of the year? Means you have an IT which is under pressure, banking financial seems to be coming back, but you have oil and gas which is again having issues with respect to geopolitical risk. Consumption seems to be back with, if we look at the Nestle numbers which have come in. So which are the key sectors? Is it only be led by banking and financial?
Sajid, I see a broad-based recovery in the economy. So obviously financials will lead underlying growth. We've seen an improvement in credit growth. Last year, credit growth was up at 14% with inflation coming in. Working capital demand will increase, so that will support credit growth. And on top of that, investment cycle continues to remain the way it is. It's somewhat anemic, but probably that's already in the base. So we're already seeing, demand from some very large investment projects coming in on the credit side. Uh, 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 for banks. So I think banks will certainly do well. But apart from that, I think probably uh, uh, probably some new sectors will open up post the spike in energy price and what it has really exposed is India's energy vulnerability. Probably will see much higher investments into the whole energy ecosystem coming in, and probably that as a sector should do pretty well. Apart from that, we're already seeing recovery in consumption, as you highlighted. Yesterday, Nestle reported the results, pretty strong results. Bear in mind that we're coming out of 2 years of, sluggish cycle as far as consumption is concerned. So what we're really seeing is there's a latent demand that exists in the economy, and past experience tracking Indian economy tells us that whenever some of these domestic demand-oriented sectors go through a couple of years of slowdown, you see a strong revival or resurgence in demand because that latent demand always exists in the system. And we see something similar in autos as well, where, after a gap of 7 years, commercial vehicle sales now last year crossed their 2018 peak, or two-wheeler sales crossed their peak of 2019 last year. So probably over the last 6 or 7 years, demand has not grown. We've just caught up with the peak that we made 6 or 7 years back, which effectively means there's a lot of latent demand in the system, which is playing out. So the underlying demand still continues to remain robust. And I think it will reflect across all of the sectors, the domestic economy oriented sectors, I would say.
Mm. Pankaj, How do you play IT at this point in time? Most of the numbers are at least means either in line or have a soft landing for IT, which is there. SCL was below expectation. Persistent, which is at trading at 2 times the valuation for the entire sector, also came up with soft numbers which yesterday. How do you look at IT? And I think you have Infosys also as one of your key picks in your portfolio.
Well, obviously, all of us have seen the sector has not really done well in the last 12 months. I think valuations in the sector are at cyclical low, or what we've seen probably at the lowest point. And the last time we saw such valuations were in 2018. What meaning one of the fundamental question which people have been asking is about probably whether these companies will shrink in terms of their aggregate size 5 or 10 years down the line. I think that question has been addressed now wholesomely, that that's not going to be the case. These companies are going through a transition where some part of their business is getting cannibalized or getting repriced, but at the same time, it's opening significantly new opportunities for these companies. So my fundamental belief remains that these companies continue to remain growth companies from a near term, medium term, and a longer term perspective. Near term, over the next 4 to 6 quarters, there is a transition that these companies are going through, because there is an existing base of business which is getting repriced, or which is having a deflationary impact. But at the same time, there are new businesses which are making up for it, and probably these companies are growing. So I think probably over the next 4 quarters, what we see is somewhat moderate growth from these companies. But I certainly think that once we are through this, these companies get back to high growth trajectory, because past experience tells us that whenever we have such significant new technology transition, it definitely leads to much higher growth curve for IT services companies. And I don't think so, meaning I don't see any reason why that should not hold true this time as well. And in fact, we are seeing initial green shoots of that as well. So my point is, when you put all of this together from a market perspective or a stock price perspective, probably markets at this point of time, valuations are at cyclical lows, and they're pricing in muted growth. But I think the growth trajectory for these companies will improve over the next 4 quarters. So for long-term investors, this is a great time to be buying into these companies and take a 3 to 5 year view. And probably I think there is a opportunity to make some outlier returns over that time horizon.
That's quite interesting. In the very near term, though, Pankaj, you've always identified more tech than IT services as we traditionally know it. Anywhere in the AI stack you think India has an opportunity, or any of the listed players which comes to your mind?
Not really, Aisha. The challenge is, whenever this foundational new technology happens, the first 5 years is all about, about companies and businesses which are associated with that foundational technology, and which is what we are seeing globally in the AI space, where the biggest money has been made either in the foundational model companies, which are likes of OpenAI or Anthropic, or the semiconductors or the hyperscalers. And India, unfortunately, doesn't have a play across either of these three. But as diffusion of this technology happens, as adoption of this technology happens, as AI gets adopted, India definitely has a play in terms of IT services, because clients will need help of a service provider. They cannot adopt and integrate the technology on their own. It's pretty complex. It's very multidimensional. So I think that is where the play for India is. As far as direct play on AI is concerned, clearly, I think the challenge with India is we don't have that kind of risk capital that is available to fund those kind of foundational technologies and models, because one, this you have to seed significant amount of losses to build this technology or companies or businesses around this. And secondly, the success rates or the probability of success is very low. For every one company that succeeds, there are hundreds of them which fail. And probably India's ecosystem, even at the VC level, does not have that kind of risk appetite to provide that kind of a capital. So obviously, on the foundational technology AI side, I think India has missed the bus.
Hi, Pankaj, this is Harsh joining the conversation. You've been slightly more sanguine when it comes to mid and small caps. At what point do valuations start to become an issue, especially given that earnings growth visibility hasn't kicked through in a significant fashion? In fact, there are more headwinds than tailwinds.
Harsh, when you look at these markets at the aggregate index level, these markets are priced to perfection. It's a market which is well researched, well discovered, and has a lot of brain power into it. So you don't find mispricing at the aggregate level. More importantly, experience tells us, and we're witnessing that as we speak, that when you go through an environment of macroeconomic challenges or macro uncertainty like the one we are in today, the dispersion in performance of companies within the sector increases significantly. Within the same sector, you will find companies doing very well, and you will find companies not doing so well. So I think the game from here on, in mid and small cap, and I think this applies now even to large caps, because we are seeing very wide divergence in performance of large caps as well. It's all about stock selection. It's not about sectors anymore, because within sectors we are seeing very wide dispersion. So it all boils down to competitive edge, competitive modes of companies, the management's execution capability. I think execution is a very important role to play. A great management can do a great execution and still deliver, positive positive growth for stakeholders, despite challenging environment, and which is where the management quality comes into play. So I would say there are significant opportunities in mid and small cap, and especially after this very sharp correction that we have seen in the last 6 weeks. But it's more stock specific. One will have to get down to more stock specific. And wherever those numbers are surprising, on the positive side, we are seeing very strong reaction to stock prices. We've seen what happened to Nestle's stock in the last few days, or to a PNB housing stock, in terms of the kind of numbers they delivered and the stock price response to it. So I think the point I want to make is, from here on, the game is going to be more about specific stock selection, and I find there are significant opportunities in mid and small cap where one can be buying into those names and make very healthy returns over the next 12 to 18 months.
Pankaj, you wouldn't give any stock ideas, would you?
We own quite a few. I think we like a lot of mid-cap financials. I can say what we own. So the caveat obviously goes that we have a bias. Within mid-cap banks, within financials, we like some of those mid-cap companies with strong management execution capability. We own names like Federal Bank and City Union Bank on mid and small cap side. Likewise, within NBFC space, we own names like M&M Finance and PNB Housing Finance. So I think it's all about now about management capabilities and execution capability, because companies which will do well will deliver much higher returns, and it's more stock specific from here.
Well, PNB housing numbers definitely would have made you extremely happy. But Pankaj, great to have you on the show today. Thank you as always for your time.
Thank you so much.
Well, PNB Housing continues to be a star performer even after yesterday's move, another 1.5% as we spot in trade right now. Let's take a very quick break. Some of the market is definitely recovering. Let's see how the next lap pans out. We'll come back with an F&O update.